Right now, a government that can print its own money is offering you a guaranteed 5% return for the next 30 years.
Which is wild.
Yeah, I mean, on the surface, that sounds like a phenomenal, totally risk-free deal for your retirement account. But for a country of over 200 million people halfway across the world, that exact same 5% return is essentially an economic death sentence. Welcome to the deep dive. We are taking your sources, specifically this really dense, highly revealing financial strategy note titled The Terminal Mirage, and unpacking the most critical insights you need to understand the global economy today.
It really is a stark contrast. I mean, the financial world right now is completely captivated by this false symmetry.
Right.
If you look at one side of the picture, you see a booming, totally invincible U.S. stock market.
Yeah.
And it's all driven by the narrative that artificial intelligence is going to trigger this unprecedented productivity boom.
Yeah, everything in the U.S. tech sector is just hitting record highs.
Exactly. But if you look beneath that surface, you see the geopolitical reality of supply shocks and a 5% baseline interest rate that is quietly but really ruthlessly crushing developing nations.
And this matters to you, the listener, even if you don't actively trade international bonds, because this dynamic is basically a masterclass in how averages, indexes, and dominant headlines can actively lie to you.
Oh, absolutely. They mask massive structural risks.
Okay, let's unpack this. I want to start with the first major theme of the strategy note. It calls the current market consensus the AI immunity doctrine. So why are the major banks treating the U.S. market as if it is completely bulletproof right now?
Well, the major institutions aren't just ignoring bad inflation data. They are actually building complex rationalizations to excuse it.
Because the raw numbers are bad, right?
Yeah. U.S. inflation is undeniably running hot. In April, the CPI hit 3.8% year over year. Core inflation is sticky at 2.8%. And the PPI, the wholesale cost, that spiked to 6.0%.
A 6% wholesale price spike is huge.
By traditional metrics, yes. It is a glaring red alert that inflation is not tamed and that interest rates might need to stay high for a very long time.
But the major players like Goldman Sachs, JPMorgan, Merrill Lynch, they're practically waving this off.
Completely waving it off. Their entire justification seems to hinge on a single, highly specific data point, which is a 0.6% month-over-month spike in the shelter component of the CPI.
Right, and they're calling this a mechanical double count by the Bureau of Labor Statistics. Wait, how does a mechanical double count even happen in federal economic data? Did someone just, add the spreadsheet up wrong?
No, it actually stems from the recent government shutdown.
Oh, okay.
The Bureau of Labor Statistics sends out surveyors to check rent prices across different cities. But because the government shut down, they missed an entire collection window.
Ah, so when they finally got back to work.
They essentially crammed 2 months of cumulative housing inflation data into a single monthly print. So the major banks are looking at this artificial spike and concluding that the underlying trajectory of inflation is totally fine.
They're claiming that energy price spikes from the Middle East are just temporary, the economic expansion is durable, and rate cuts are still on the table.
Exactly.
So the banks are essentially treating inflation like a malfunctioning check engine light on your dashboard. They're telling investors to just ignore the flashing red light because the sensor itself is broken.
Yeah, that's a great way to put it.
And besides, the new AI engine under the hood is simply too powerful to fail. I mean, BlackRock just made a massive portfolio shift that perfectly illustrates this mindset.
What's fascinating here is that it is arguably the most revealing positioning shift we've seen all quarter. BlackRock explicitly downgraded high-yield credit, meaning riskier corporate debt, to a neutral weighting.
Okay.
And simultaneously, they upgraded developed market equities to an overweight position.
So they are telling the market exactly where they want to take their risk, and it is not in debt. But why move aggressively into stocks when bond yields are this attractive?
Because of the time frame.
Yeah.
BlackRock is bidding on a strategic horizon of 5 years or more. This is not a cyclical guess about whether the Federal Reserve cuts rates next month.
Right, this is structural.
Yes. It's a structural belief that multi-year AI productivity gains will compound so massively that the tech sector can generate record profits completely, regardless of the cost of capital. They believe the tech industry can bypass the interest rate cycle entirely.
But if BlackRock is betting the tech sector can simply ignore high interest rates, who is left holding the bag? Because someone has to actually pay these borrowing costs in the real world.
Precisely.
Which brings us to the bond market. Let's look at the actual consequences of a 5% reality. The U.S. government recently auctioned off a 30-year Treasury bond, and it cleared at a 5% yield. The last time we saw that was back in 2007.
Yeah, and a 10-year Treasury is sitting at 4.59%, and the U.S. dollar is surging.
But the street is treating that 5% auction like a passing headline.
They are. But mechanically, it is a structural verdict on the global financial system. When the U.S. government establishes a 5% floor, it alters the baseline physics of global capital.
Walk me through the actual mechanics of that. If I'm, say, an institutional fund manager sitting in London with $1 billion to deploy, how does that 5% U.S. Treasury physically drain capital away from a developing nation?
It all comes down to risk premium. If you are that fund manager, your primary job is to generate returns while protecting your client's capital, right?
Right.
So if a frontier economy, say a developing nation in Africa or South Asia, wants you to buy their sovereign bonds, they have to compensate you for the risk that they might default.
Or that their currency might collapse.
Exactly. Historically, if the U.S. Treasury was paying 1 or 2%, you might be willing to lend to that frontier nation for 6%. You take on more risk to get a better yield.
Because 6% is a lot better than 1%?
Precisely. But today, the U.S. Treasury, which is backed by the printing press of the world's reserve currency, is offering you 5% risk-free for the next 30 years.
So as a fund manager, you look at the 6% offered by the developing nation, and the math just no longer makes sense.
Why take on massive geopolitical risk for a mere 1% premium?
You wouldn't.
Right. So you sell your developing market bonds, convert that local currency into U.S. dollars, and buy treasuries. Multiply that by thousands of institutions globally, and it acts as a giant financial vacuum cleaner.
Wow.
It violently sucks capital out of the developing world, driving the value of their local currencies down and forcing their borrowing costs sky high.
And that completely contradicts the assumptions baked into the global financial architecture. The strategy note highlights that the International Monetary Fund, the IMF, held their spring meetings just a few weeks before this auction.
Yes.
And in their structural audit of developing countries, their medium-term projections assumed that global risk-free interest rates would eventually normalize.
The IMF's models were essentially built on the assumption that the era of cheap borrowing would eventually return. I mean, since the 2008 financial crisis, the world has been addicted to 0% interest rates.
Right. It became the baseline assumption for how governments roll over their debt.
But a 30-year Treasury clearing at a concrete 5% floor explicitly shatters that assumption. The era of cheap money is definitively over.
Okay, let's look at exactly who gets caught in the gears of this vacuum cleaner. The strategy note points to two real-world casualties being squeezed by high borrowing costs and high global energy costs, which are Pakistan and Egypt.
Let's start with Pakistan.
Yeah, they are operating under an active IMF extended fund facility. Essentially, they are on a strict financial lifeline.
And the math for that lifeline is already obsolete. The IMF identified an external financing gap for Pakistan, meaning the shortfall between what they owe the world and what they earn, and they calculated a bailout package to cover it.
Right.
But that calculation was made last December, assuming a much lower trajectory for global oil prices.
But right now, West Texas Intermediate crude is sitting over $100 a barrel. So what is the mechanical problem with their IMF lifeline? If the price of oil goes up, why doesn't the IMF just wire them more money to cover the difference?
Because IMF programs are incredibly rigid. They disperse funds in strict pre-approved tranches based on painful domestic policy reforms.
Like cutting subsidies or raising taxes.
Exactly. They don't just write a blank check because commodity prices moved. Pakistan has to import almost all of its energy. So every single week that oil stays above $100, their import bill balloons.
And they are bleeding their dollar reserves just to keep the power grid running.
Yes.
And this ties back to that 5% vacuum cleaner. When Pakistan's old, cheap debt matures, they have to issue new debt to pay it off, right? That's the rollover process.
Right.
But now, to convince investors to buy that new debt instead of a safe U.S. Treasury, Pakistan has to offer exorbitant interest rates, maybe 10 or 12%. So they are draining their cash to buy expensive oil and simultaneously taking on suffocatingly expensive new debt just to survive.
It is an entirely unsustainable squeeze. Now, contrast that with Egypt, which has a different vulnerability entirely. Egypt relies heavily on capital inflows from the GCC, the wealthy, oil-producing Gulf Cooperation Council states.
Okay.
The IMF's projection for Egypt's survival is fundamentally contingent on those Gulf states continuing to pump billions of dollars in bilateral support into the Egyptian central bank.
Wait, I need to push back on this logic. Aren't those Gulf states massive oil
They
exporters?
are.
So if oil is sitting above $100 a barrel, shouldn't Saudi Arabia and the UAE be flush with record cash surpluses? They should have more than enough capital to bail out a neighbor like Egypt?
No, if we connect this to the bigger picture, the geography actually reveals a critical hidden mechanism.
Yeah.
Yes, the Gulf states are commodity exporters, but why is oil over $100 right now? It is largely because the Strait of Hormuz, the primary shipping artery for Middle Eastern oil, is effectively closed due to geopolitical conflict. That closure doesn't just block Western ships. It blocks the Gulf states' ships, too.
So they can't just sail their oil at the front door.
They cannot. They are being forced to reroute their tankers all the way around the Cape of Good Hope at the bottom of Africa.
Which adds weeks to the journey.
It adds weeks, and it requires massive amounts of extra fuel. Plus, the insurance premiums for maritime shipping in conflict zones have completely skyrocketed.
Wow.
So while the headline price of oil is generating more top-line revenue, the actual internal logistics costs are absolutely eating them alive. Their profit margins are shrinking.
Which means the excess capital they would normally use to act as a regional financial backstop, like propping up the Egyptian economy, is suddenly tied up paying for fuel and insurance on their own ships.
Exactly.
And to make matters worse, Goldman Sachs noted that hopes for a U.S.-Iran peace deal have essentially evaporated. So the geopolitical tension keeping that shipping lane closed is locked in.
Yeah, the same structural shock that the market casually reads as a net positive for Gulf sovereign wealth is mechanically draining their capacity to stabilize the region.
Here's where it gets really interesting. If Pakistan is suffocating under oil prices and Egypt's bailout money is being eaten by shipping logistics, why isn't the emerging market index crashing?
That's the big question.
If I look at the MSCI EM index, it doesn't look like a global sovereign debt crisis is unfolding. In fact, a couple of weeks ago, it surged nearly 7%.
This is what the strategy note calls the refraction effect. The index is fundamentally broken. It projects a false reality.
It's like grading a massive group project in high school, right?
Yeah, exactly.
The emerging market index is heavily weighted toward Asian technology hardware exporters, specifically companies like TSMC in Taiwan and the KOSPI index in South Korea.
Yep.
Taiwan's semiconductor industry is the one straight-A student doing all the work, pulling the group average up to a solid B+. Meanwhile, countries like Pakistan and Egypt are getting straight Fs and failing out of school. But because passive investors only look at the final group average, nobody realizes the back half of the classroom is literally on fire.
That's exactly the mechanism. The index is market cap weighted. As the AI boom accelerates, those semiconductor companies grow in value, taking up a larger and larger percentage of the index.
Right.
The economic framing we see in the U.S., durable expansion, heavy AI capital expenditure, is incredibly accurate for those specific Asian tech companies. But it is dangerously misleading for the frontier credit tier.
Because a passive investor buys an emerging market ETF thinking they are getting global diversification. But really, they are buying a semiconductor fund that has a bunch of toxic, failing sovereign debt hidden inside it.
And that hidden debt is getting substantially more toxic due to a specific mechanism called negative carry drift.
Let's slow down here. Walk me through the exact mechanics of a carry trade and why it is drifting negative right now.
So in emerging market finance, a common institutional strategy is the carry trade. An investor borrows money in a currency with rock-bottom interest rates, historically the Japanese yen or the euro.
Okay.
Let's say you borrow yen at 0.1% interest. You convert those yen into US dollars, and you use those dollars to buy high-yield frontier bonds, like Egyptian debt, paying 8%. Your profit is the difference between the 8% you earn and the 0.1% you pay to borrow.
You basically carry the yield.
You carry the yield, yes.
But the Bank of Japan and the European Central Bank aren't playing that game anymore.
Right. The environment has totally flipped. The Bank of Japan is gradually raising rates because domestic Japanese wholesale inflation, their PPI, just hit 4.9%.
Oh, wow.
Simultaneously, the Japanese yen has been incredibly volatile, and the ECB is solidifying their own rate hikes. The fundamental cost to borrow those funding currencies is rising rapidly.
So mechanically, the 0.1% you are paying to borrow yen suddenly jumps to 1 or 2%. Meanwhile, the Egyptian bond you bought is getting riskier, and its value is dropping because of the strong US dollar.
Yep.
So your funding costs are actively rising faster than the income your investment generates. The profit margin just collapses.
That's negative carry drift. It forces investors to liquidate their positions.
Hmm.
So if you buy the broad EM index, you inherit all the downside of this mechanical squeeze.
The rising funding costs, the spread widening caused by that 5% U.S. Treasury floor?
Exactly. You get all of that without actually capturing the pure AI upside, because that's concentrated in a handful of tech stocks. The index has essentially become a financial trap.
Well, if the broad index is a trap, how do we find actual value? I mean, we need to look for specific countries that are fundamentally strong but are being dragged down by the failing group average.
Yes.
And the strategy note highlights one massive divergence opportunity, which is Morocco.
Morocco is actually doing the fundamental work. If you audit their national balance sheet, their reality is completely divorced from the panic-suffocating Pakistan or Egypt.
Because they saw the energy trap coming. Right. Unlike those other nations that have to import expensive geopolitical risk-heavy crude oil, Morocco has spent years heavily investing in domestic renewable energy, massive solar and wind infrastructure.
Right.
So when the Strait of Hormuz closes and oil spikes over $100, Morocco isn't bleeding out its dollar reserves just to keep the lights on.
And more importantly, they are executing what the IMF calls a fiscal consolidation plan.
Meaning what, exactly?
To translate the jargon, their government is actively bringing in more revenue through taxes and economic growth than it is spending on baseline government services.
Okay.
The IMF's recent assessment explicitly documented that this trajectory allows them to mathematically stabilize and pay down their national debt, even in this high-rate environment.
So what does this all mean for the actual market? If Morocco is mathematically secure, building renewables, and managing their debt, why are their bonds trading at a massive discount alongside failing nations?
Because of institutional laziness, honestly, and passive index mechanics.
How so?
When a massive global ETF gets a redemption order, say, because investors panic over a strong US dollar, the computer algorithm doesn't read Morocco's balance sheet. It just proportionally sells everything in the emerging market basket.
So Morocco's bonds get liquidated just as aggressively as Pakistan's.
Exactly.
It's just indiscriminate selling.
Completely. The market is pricing Moroccan debt as if they are facing the same existential crisis as the rest of the index, which the fundamental data proves is false.
And this structural disconnection is exactly where the smart premium lives. Eventually, institutional capital will recognize the mispricing. They will realize they can buy perfectly healthy Moroccan sovereign debt at a steep discount simply because it shares an index ticker with struggling countries.
Precisely.
Bringing this all together, the terminal mirage is the dangerous collective hallucination that the U.S. tech sector's immunity to high interest rates applies to the global economy.
It doesn't.
It doesn't at all. You cannot simply slap an artificial intelligence label on a global index and pretend the underlying mechanics are sound. A 5% floor on a 30-year U.S. Treasury, paired with structural energy shocks, is actively rewriting the survival math for the developing world.
To navigate this, you really have to look past the benchmark averages. If you just buy the index, you inherit the sovereign debt crisis. True insight requires looking at the actual country-level balance sheets.
Because that 5% yield is not a temporary anomaly.
No, it is the new concrete foundation of global finance.
The tide of cheap money is gone, and we are finally seeing who is swimming naked, which leaves us with one massive lingering implication to consider.
This raises a critical question for the next decade. If the U.S. dollar and U.S. Treasury yields become a weapon of structural destruction for developing nations,
creating endless, suffocating rollover crises for countries that simply cannot compete with a 5% risk-free rate.
exactly. How long before those nations simply stop playing the game?
We're talking about structural abandonment.
Right. If the Western financial architecture mathematically guarantees their insolvency, do we see a massive, accelerated de-dollarization? Are we watching the catalyst that forces the developing world to abandon the U.S. Treasury system entirely, seeking emergency non-dollar lifelines from alternative powers like China?
That's a staggering thought. The Mirage is believing the current system can squeeze the globe indefinitely without the globe eventually deciding to build a new system altogether.